Good afternoon, everybody, and thank you for assisting to this webinar presented by SQ Insurance. My name is Jean-François Pakenham, Fund Development Center Advisor. We are pleased to welcome today Jeff Scott, Portfolio Manager at Cambridge Global Asset Management, here to talk about the recent performance of Cambridge Asset Allocation Corporate Class. Please note that if there's enough time at the end, it will be our pleasure to answer one or two questions that you can ask via the Q&A section of the WebEx interface. You can also communicate with your SSQ insurance representative for all other questions. So without further ado, Jeff, the floor is yours.
Thank you very much. Hi, everyone. Thank you. Great to be here today and speaking to you on behalf of Cambridge Global Asset Management and speaking today about the Cambridge Asset Allocation Fund that we manage on behalf of you and your clients. I thought we'd spend some time today just going over the firm, Cambridge Global Asset Management, talk a little bit about our team and introduce some of the key people who are making decisions on this fund on a day-to-day basis, and get into a little bit about our firm philosophy and how we go about investing. And finally finish off with some positioning around the portfolio and how the strategy has performed over the last number of years. So to get right into it, slide 4 is a slide that speaks to our the history of Cambridge and just talks a little bit about where we came from and like I said, our history. So we were established first in 2007 as a division of CI, and we were established by a gentleman named Alan Radlow, who had a long career of managing portfolios for investors in Canada at Fidelity Investments prior to joining Cambridge and founding Cambridge back in 2007. From those early days to really the firm took a bit of a turn in 2011 when Alan recruited a number of team members that he used to work with at Fidelity, and they came to the firm and joined Cambridge. So it was really, since 2011, the 5 of them have really taken the firm and grown it from a $2 or $3 billion firm to the 20+ billion that it is today. And we're about 15 investment professionals now. We're located in Toronto and Boston. And one thing that you should know and take away from these interactions that you have with Cambridge, or if you ever run into us in the future, is that we're very much focused on security analysis and really understanding the investments from the bottom up. Fundamental research is core to what we do, and really understanding the competitive advantages of businesses, how they differentiate themselves within their industries, and how they can create sustainable value for shareholders. That's what we spend most of our time on, and that's where we focus when we build portfolios. So you can see how our assets are broken down. Canadian equities, fixed income, and global equities is the largest portion. So turning the page, this is a little bit more on our team, and this is who are, like I said, making decisions on your behalf on a day-to-day basis. So beginning with the top row there, you see Robert Swanson, Brandon Snow, Paul Mocoglisi, and myself, Jeff Scott. So the key decision makers on this portfolio, and I would highlight Robert Swanson, Brandon Snow, and Paul Mocoglisi, as they're voting members of our asset allocation committee and are setting the asset mix of the fund. Really deciding on how the fund is allocated between equities, fixed income, and cash. And they do this on a quarterly basis or any ad hoc basis as necessary if market events dictate that. But really, they are the key decision makers. And Robert Swanson, you can see his title there is Chief Market Strategist. So he'll really bring a lot of economic data to the table. Brandon Snow, he's our CIO. He leads our equity research team and really drives the research agenda there. And he's responsible for equity selection within the portfolio. And Paul Mocoglisi, he's our fixed income PM. He spent about 19 years prior to coming here. He had a long career at McLean Budden and then at MFS Global Asset Management prior to joining us here. So he's a long history of managing fixed income and managing bond portfolios. And finally, myself, I spend a lot of time speaking with clients on behalf of the team. I'm fully integrated into the team and a member of that asset allocation committee and join those discussions also. And for my background, I spent some time in security analysis and in equity research. I spent about 5 years of my career there, and prior to that, portfolio analysis and really understanding risk exposures of portfolios. So I bring a different lens to the team and really help to guide some of those discussions and understand how the portfolio is exposed and positioned on an ongoing basis. Underneath that, you can see, Alan Radlow. He's not as involved today, but he's, still involved in some of the discussions around, more informal. On a formal basis, he doesn't manage portfolios anymore. And Steve Groff and Greg Dean are also partners of the firm, and they manage equity portfolios on behalf of Cambridge. Also supported by a team of analysts and the training as well as back office support from CI. So with that, I can turn to page 6, which talks a little bit about our philosophy and how we go about managing investments on a day-to-day basis. And this is consistent with, this philosophy isn't just for this strategy. It's really, it's ingrained in everything we do, and it's common across every strategy that we manage at Cambridge. And it really begins with, a fundamental approach, like I said. A deep bottom-up fundamental research is really what we do. We spend a lot of time getting to know businesses, understanding their competitive advantages, what makes them tick, what are the key drivers to their business. And what this does is we really end up building portfolios that, from the bottom up. And they tend to be very, different than the benchmark because we don't use the benchmark as a starting point. We're really looking at a blank sheet of paper and trying to determine what are the best risk-reward opportunities in the marketplace and how can we get exposed to those within our portfolios. So we end up, active share is something that we've talked about a lot in the past, and you can see that in our portfolios is really, coming at investing from a benchmark agnostic perspective and building portfolios that are differentiated and just based on the risk-adjusted returns that we see. The second pillar in the middle of the page is these value-creating businesses. So we're really trying to focus on quality businesses and identifying businesses with sustainable competitive advantages. And that's making sure that these businesses aren't just generating good cash flow and look good today, but it gives us confidence that they'll look good in the future and continue to generate good cash flow for our investors. And a part of that is also making sure that we pay the right price for these businesses. I think you probably heard the expression before that, a good business can be a poor stock if you buy it at the right price. So making sure that we're buying these quality businesses at the right price is also very important to us. And again, this bottom bullet is just focusing on identifying unique insights about businesses, and that's, where do we have a differentiated view relative to what's, commonly described in the marketplace or commonly known in the marketplace. So making sure that we see something a little bit differently. And I don't necessarily mean contrarian, but that's something that, maybe it could be used to describe us from time to time, but just having a differentiated view relative to the market. The final pillar of our philosophy is just this idea of ownership mentality. And, we are stewards of our clients' capital, and we take that responsibility very seriously. Across Canada, we have nearly, we touch the financial lives of nearly 400,000 Canadians. And again, that's a responsibility we don't take lightly, and we take our jobs very seriously. And one way we do that is by, making sure that all the investors, all the employees at Cambridge are co-invested alongside our investors and our clients. Making sure that everyone at Cambridge is aligned with our clients and has skin in the game, and making sure that they're trying to drive the best outcomes in our portfolios on behalf of our clients. That makes a lot of sense to us, and that's something that we've mandated across the firm. One area where we've taken this another step further is in our investment philosophy. We make sure that the executives and the board members and that the compensation structure within the businesses that we're investing in is aligned in the right way. Making sure that return on capital or cash flow or revenue growth, making sure that these factors that are important to us are also drive the compensation metrics of the executives that we're investing with. So that alignment is very important to us, and and as I outlined, we come at it two ways: making sure that we at Cambridge are aligned with our clients, and making sure that the executives and the companies that we're investing in are also aligned with our clients and trying to appreciate trying to see total shareholder returns over the long term. So that's really our philosophy in a nutshell. And now, flipping the page to slide 7, just talking a little bit about our competitive strengths. So as I outlined there, really we have a focused research model. We're really targeting businesses that we can, gain conviction around, and we're willing to hold large weights in those names if we have a very strong risk-adjusted idea that we can take a differentiated view on. And of course, that's driven by our fundamental bottom-up process. This investment process that I'm describing in our philosophy, it's consistently applied, and that risk-reward methodology, and making sure that we understand the downside of a potential investment, and that we're getting compensated for what we see the potential return from that investment. So making sure that there's strong upside in the name relative to the downside is also part of our philosophy, and something that we consistently apply across all the funds that we manage. And then this final point of capital preservation. We focus a lot on making sure that we understand the risks in business, and we do this in a number of ways. Like I mentioned, the risk reward and understanding that we understand where a downside price is that we would be interested in the stock. But even when we do our team meetings, when we talk about our, when we have our investment meetings, which we do weekly every Friday afternoon, we're really focused on what can go wrong with this business, making sure that we understand those potential negatives that could impact the business and potentially impair financial value for our clients. And that's something we spend a lot of time focusing on downside, so that when a stock gets there, if a stock ever does get to that downside number, we can act quickly, and we can fill a position very quickly because we've done the work already. So that really, in a nutshell, talks about the firm. And now just to take it into a little bit deeper and digging into the strategy a little bit, you can turn to slide 9, and that just goes through our objectives, our philosophy, and then the strategy a little bit more detail. So really, just to start it off and look at the objective of what this fund, our asset allocation fund, is supposed to achieve or is striving to achieve, we're really focused on preserving capital. As I mentioned earlier, in one of our strengths, we spend a lot of emphasis on owning those quality businesses and understanding what can go wrong, and trying to identify these businesses that will grow and compound value over time in a fairly linear way, and trying to smooth out the ride for our clients. Our philosophy, as I went into a little bit earlier, focusing on these value-creating businesses and taking our bottom-up approach, is trying to understand, take a differentiated view and understand, potentially see something a little bit differently in these businesses. What this leads to is because of that fundamental analysis that we do and spend so much time there, it allows us to have a lot of conviction around the names that we're investing in, so that we can build large positions, as I mentioned, and tend to have fairly concentrated portfolios. And when you look at our equity portfolios, they tend to be between 30 to 50 names, depending on which fund you're looking at. And what I mentioned earlier, high active share, because we're starting from a benchmark agnostic place. Obviously, the fund's diversified by sector and countries and asset classes, and that's part of the value proposition. As this strategy is trying to achieve, like I said, trying to achieve the risks and target the risk profile that our clients are looking for. We're also active in our strategic asset mix, and also the tactical asset mix, and those shifts in portfolio positioning through time to try and capture opportunities that are in the marketplace. And we try and enhance value, and sometimes it's because we see an opportunity there, but sometimes it's also because we're trying to mitigate risk and avoid some potential drawdown in the market. And as I mentioned earlier, our asset allocation decisions are made by the Cambridge Asset Allocation Committee. And this is, again, a committee of Robert Swanson, Brandon Snow, and Paul Marcoglisi, who decide on what the asset mix is, and their decision between investing in equities, fixed income, or cash. So with that, slide 10, talks a little bit about what's happened in the fund over the last year and a half, and just really what we've done so far this year. So if you go back to 2017, 2017 was really what can be characterized as a risk-on year. Equity markets around the world did great. It was one of the best years in a long time, and we actually lagged slightly in this year. And one of the reasons we did was just what we saw when you decompose the returns and looked at what was driving the market. It was a lot of momentum-driven names. It was a lot of high-growth names. There was a lot of euphoria around Bitcoin or cryptocurrencies in general, or marijuana stocks. Those aren't areas of the market that we're going to thrive in. And when it comes to Bitcoin or cryptocurrencies or some of these marijuana companies, these aren't companies that have a history of creating value for shareholders, and they don't meet our quality criteria. So it's an area that we're just not going to invest until we see, again, going back to making sure that we see a sustainable competitive advantage in these businesses. So this conservative positioning, so we were conservatively positioned from an asset class perspective, and also within the securities we did choose. I think we sold a few of them too early, and then some of this momentum and growth took over, and we were just we lagged slightly. But what we saw, as we entered this year, and particularly into February and March, is the same factors that were driving a lot of outperformance last year and in January. That turned rather quickly, and the positioning that we had, through the end of last year and into this year, that began to pay off. Where we saw some of that downside protection. We were still underweight equities and overweight fixed income, but what changed is the market dynamic and what the drivers of the market were. So that conservative positioning began to pay off this year as we saw some outperformance given the volatility that we saw. Also through Q1, when we saw the market down, when we had the first correction in a number of years, we were able to reduce some of our cash levels and take advantage of this opportunity by deploying it, selectively into certain areas of the market where we saw good risk-adjusted return and we started to see good value. Some of the areas that we saw better value in were interest rate sensitives. If you think back to the beginning of the year, interest rates were rising abruptly, so it was sending a lot of these interest rate sensitive stocks lower. And then we got the market sell-off at the end of January into February on top of that. So we had a lot of names that we thought were pretty defensive businesses, utilities that, we haven't owned utilities in this fund for many years, but we started buying them earlier this year. Amira was one in Canada. Hydro One was another one in Canada that we've added this year. Some of these interest rate sensitive stocks, and even in the U.S., like some U.S. telecom names, like Verizon is a name that's added to the portfolio early this year. We think it's a great business, and all these names are yielding, 4+% in terms of dividend yield, and we also believe that they can compound earnings and compound cash flows at a mid to high single-digit rate going forward. So you're getting paid a nice dividend. You can compound growth going forward, and again, these are businesses that have huge infrastructure set up, so it meets that competitive advantage, and it's difficult for other businesses to come in and just take their business. So we like them very much, and they got to a point where the valuation was attractive and that risk-adjusted return profile was attractive, so we managed to buy a few of them. Finally, focused on delivering alpha through security selection is the final bullet. That's definitely, as I went through a process, I think you're getting that from us, but we're always focused on trying to identify securities with the best risk-adjusted return figures, and that's really where we thrive, and really where we, if you look at our return attribution through our history, stock selection has been by far the biggest driver of that, and that's what we expect going forward too. Turning the page to slide 11, you can see what our asset mix through time is on the top chart. It breaks it down by fixed income, equity positions, cash, and alternatives. On the bottom chart, you can just see our geographic positioning broken down by Canada, U.S., and other, which is other is just international equities for the most part. The top chart you can see, and this goes back, and I like it because this goes back a decade. And this fund does have fairly wide bands around what the asset mix in the fund could be. But you can see back in 2011, 2012, 2010 even, 80 or 90% equity in this portfolio. That was a significant equity weight at the time when the opportunity in our mind was there. That was, after the fall of the Great Recession, valuations were beaten up. There was a huge opportunity, really a generational opportunity in equities. So we managed to capitalize on that, and we're able to capitalize on that opportunity within this portfolio, given its flexibility. Fast forward to today, and you can see that over the years, our equity positions have been coming down, and that's been coming down as that return opportunity or the risk-adjusted return potential of equity markets has changed. And really, as equity markets have risen, the multiples have really risen with that, and it's really created a different view for what that potential downside risk could be. Even if you go back over the last, take the S&P 500 for example, and if you go back over the last 2 years, or really back to, I guess, early 2016, the market as a whole is up about 30% or so since that time. about 2/3 of that is driven by multiple expansion. So really the earnings base hasn't changed that much, but we've seen significant multiple expansion over the last 2 years. And that's driven some of this more conservative positioning across our funds because, again, going back to our philosophy, we're trying to preserve capital, and when the opportunities aren't there and there's more risks in the market, we're going to pare back, and we're going to pare back our risk exposure, and we're going to hold fixed income investments, which we think have a different risk profile, obviously, or we'll hold cash. You can see also that our fixed income investments have risen over time. That's as Paul Marco Glazzi, who I mentioned, manages our fixed income portfolio. He's joined about 2 years ago, and he's really taken our fixed income team to another level. And there's a small alternatives position, and that would be just some options rating that we do to try and generate some extra income for the portfolio. Now, on the bottom chart, you can just see our exposure across geographies. Largely Canadian, with some U.S. complemented in there, but also some international. Some names internationally that we're finding, or some areas of the world where we're finding more opportunities today would be the UK. And what we're seeing there is there are some good businesses that are getting, caught up in, what would be a macro headwind around some of these concerns around Brexit and how the European economy is, the UK economy is going to grow going forward as it disentangles itself from the European Union and from the currency. But really, that's creating opportunities in what we see as good quality businesses. Melrose Industries is an example of that, and it's somewhat of I guess you can call it, they make acquisitions, or it's a listed private equity vehicle. But this is a great company that's managed to create a lot of value for shareholders over the time and compound returns for them. They're in the midst of an acquisition with a new company that they've just bought, and they're going to try and improve the operations there, and a lot of that, the benefit will accrue to shareholders, and we think the stock is very attractively valued at these levels. So it's an example of where a macro headwind has created opportunities at the stock level, and we're able to apply our fundamental approach and fundamental process to try and sift through these ideas and generate good risk-adjusted return opportunities for the fund. We can flip the page again. We can talk a little bit about, this slide 12 just lists the long-term performance of the fund. You can see the one-year number is more challenged, and that's, really, like I said, driven by that more conservative positioning that we've held in the portfolio. You can see our 2017 number, similarly, given that more conservative positioning. But if you rewind the clock over time, our 5- and 10-year number, we managed to create significant value for our clients, and that's really just being able to capitalize on those opportunities. And this mandate is flexible enough to be able to move within asset classes when the opportunity is there, and that's what we've done here. But really, this is just more for your information. I think I've spent enough time there, and can just move on to the next slide, which is some more risk parameters around the portfolio. And this compares, you can see our portfolio relative to the category average, relative to a benchmark, and relative to an ETF balanced portfolio. The returns over time, the alpha we've generated, the alpha is obviously very strong over the track record, and this is a 5-year figure. But I'd also point to the beta of the portfolio, or the standard deviation of the portfolio, which is quite a bit below it's almost in line with the benchmarks, but the beta is a lot lower. The correlation benefits, again, quite a bit lower than relative to the peer group or the index overall. And again, starting, if you think about our process and being benchmark agnostic, starting with a blank sheet of paper, we're really building differentiated portfolios here that could complement what you're doing in other areas of your portfolio very well. A very strong Sharpe ratio over time, and we've highlighted the upside downside capture ratio, which is a good way to measure kind of, I guess this is an output, but it's a good way to kind of a proof point to show that what we're doing in the portfolio makes a lot of sense, in that we may not capture all the upside in a rapid bull market, but it's on the downside where we're going to create a lot of value and where we'll outperform relative to peers or relative to benchmarks, and where we've been able to do that through time, and this just really shows that and illustrates that. So I think that touches on that, but just making sure that I think this is a great slide that shows and is the proof and the output that what we're doing in the portfolios and trying to create value for shareholders by finding attractive risk reward for them, that's showing up in the risk figures and in the upside downside capture ratios, which is something that we like to see, obviously. Finally, with that, I think we included some other slides in the portfolio around just more on our asset allocation committee, how they make decisions, and this is more for your benefit to go through. Unless there's any specific questions, I think that's I've kind of exhausted the slides here, and please, if you have any questions, please feel free to ask them.
Thank you, Jeff. We'll now proceed to answer some of your questions. So we have a few questions in the Q&A section. Can you please talk about Cambridge views on Canadian bank?
Yep. So yes, the Canadian banks that's an area that we actually get a lot of questions here. Unlike a lot of so this is an asset allocation fund, obviously, but there's a large Canadian equity component in there, and unlike a lot of Canadian equity managers, we actually don't own any of the Canadian banks. It's an area that we've been away from for a lot of years, but the returns on our Canadian equity funds have been very strong still, and we've been able to generate returns in other areas of the market. So really, not owning the Canadian banks is really going back to our process of what's the upside relative to the downside. And at this stage in the cycle, given where we are in the housing cycle in Canada, the levels of consumer indebtedness across Canada, that gives us some concerns in that Canadians are very indebted. And the balance sheets, we don't think would, the household balance sheets of Canadians would have a tough time handling a very, a recession or a very significant recession. So it's an area that we have some concerns. And, what this could lead to is just, the banks, having if the credit cycle were to turn, it's been a big driver of Canadian banks' earnings growth over the last number of years, and that could slow. So we have some concerns around, like I said, Canadian credit, housing, that have caused us to take a little bit more of a cautious view on the banks, because we see, really, what is an unattractive risk-reward opportunity there. We have other areas of the financials sector that we do have exposure. Intact Financial is a name that we own. We own some U.S. financials, we own some insurers in terms of Athene or Chubb, but it's just not the Canadian bank specifically. And actually, one thing, if you're interested, we actually just put out we publish blogs periodically, and just last week we published a blog on why we don't own the Canadian banks. And it was actually an update to a previous blog that we did about a year and a half ago. But if you're interested, you can go to our website, go to our blog section. We put out a big document around why we don't own the Canadian banks, so there'll be more detail there if you're interested.
Okay, thank you. We have another question. What are some international opportunities that you are finding right now?
Yeah, so I mentioned Melrose Industries, which is a UK-listed quasi-industrial firm that I think is a great way to gain some international exposure. It's something that again, those macro headwinds in the UK are creating an opportunity there. I think in the U.S. there's other names. Like, I don't know if you mean international outside of North America, but in the U.S. there's also some great companies that we're finding ways to get exposure in this portfolio. In the tech world, I think two names that are held in this portfolio are Activision Blizzard and EA Sports, and they're basically video game. They come from their heritage. They make video games. That's a big part of their businesses. They're tied into this theme around esports, which is really growing significantly right now. But it's, again, both great companies that we think are attractively priced and offer very strong risk-adjusted returns for our clients.
Okay, thank you. We're going to take just a last question. Can you please talk about Cambridge views on the sustainability of the recovery in oil? How does this manifest in your exposure to the energy sector?
Right, okay. Yeah, so with the run in oil that we've seen over the last, call it, 6 to 12 months, at the end of last year, we were actually finding quite a bit of value in the energy sector. actually particularly in Canada, because the Canadian energy sector was just really punished, and a lot of even the corporates were selling down their energy exposure because they didn't want exposure to the oil sands. So that was what we thought was a very good opportunity in the energy sector with oil prices around $50 or so. Fast forward to today, where energy prices have obviously rallied significantly since those levels. We've actually been trimming our exposure in a lot of in our energy holdings. I think Canadian Natural Resources is a name that we've held for a while, but that's one name that we've been cutting back and reducing, just because that return, or that risk-adjusted return profile, we just don't see as attractive today. And really it comes down to, obviously, oil price is of the commodity is the biggest driver of these oil stocks. But the nature of the market has changed significantly over the last number of years, where there's a lot of lower cost supply that's able to come to the market quickly, in terms of a hydraulic fracturing coming out of the U.S., particularly the Permian Basin. The Permian Basin is offering cost per barrel of oil around $10 now. That's significantly lower than it was even a couple of years ago, where it was up around $30. The oil sands is, cash cost per barrel for C&Q is around $18 or $19. And they just bought the Athabasca oil sands property, and that the cash cost on that oil was $25, and they're driving that down towards their corporate average. So with the cost to bring an barrel of oil to market, $20 at the pump, and then any transport fees, $70 oil seems fairly unsustainable in our view. We're in a funny period here where there was a lack of investment going back 2 years ago after we saw the big decline in oil. So we're kind of in that sweet spot for oil prices right now. But over the next number of years, I would expect there to be a cap on oil prices, and for oil prices to be, in this kind of $50 to $60 range longer term.
All right. Well, thank you, Jeff, for taking the time to talk to us. Very
Great.
much appreciated. So this concludes the presentation. To all who have listened to the webinar, thank you for your participation, and come back to the next webinar. Thank you, and have a great day.
Thank you very much.